Hello there, everyone, and thank you so much for joining us. I'm Sam, and I moderate these weekly presentations. And in just a second, we're going to be joined by Wesley Boudreau, who's going to be giving you some year-end tax tips you can use to save some money when you do your 2024 taxes. Before he comes on, I'd like to just very quickly remind you we are not affiliated nor endorsed whatsoever by any specific company. We are a completely independent group of financial advisors here. You will see some links popping up on your screen as you watch this webinar today. They will guide you to several different resources we have available, one of which may simply be a link to book an appointment with Wesley or one of his colleagues if you wish after the presentation has ended. And very quickly, I'd also just like to apologize in advance. We are not going to be taking any questions today, but please feel free to still enter them in the Q&A box. It's completely anonymous. And I will make sure one of our financial advisors gets back to you after the presentation, either through phone or email, to address those with you in person. And without further ado, let's jump right into it with Wesley Boudreau.
All right, thank you very much, Samantha, for that introduction. Like she said, we are going to be talking about taxes here for 2024 as we wrap up the year. We'll talk about some different planning strategies as we lead into the end of the year versus simply waiting until the beginning of 2025 when it may be too late for some of these potential strategies. We'll talk about also what it means to have a financial plan or a written plan to focus not just on taxes, but on your long-term planning, retirement planning. We'll remind you who the retirement group is and what type of services we can provide you to help out as well. As far as some of the things we'll get into, again, we'll talk about some updates in the standard deductions. We'll talk about the marginal tax rates, how those are affected right now in 2024 and potentially beyond. Retirement contributions, how those have bumped up a bit with inflation. Estate and gift tax exclusions, as well as some special tax provisions that you may need to be made aware of going forward. As far as the standard deductions, this is something that changed back in 2017 after the original Trump tax cut. So there were some questions here leading into the elections, whether or not we'd see some changes in 2026. There's still those questions, but obviously with the election coming through, chances are we'll still see these higher deductions and a similar type of tax treatment going forward in 2026 and beyond. But they're pretty high now. So it used to be a lot of people were able to take tax credits and deduct expenses and things of that nature in order to get their taxes down. But a lot of people don't have to do that anymore because of these higher standard deductions. So moving forward for 2024, it's been inflated up to $29,200 for a married couple. If you're head of household or single, it's going to be $14,600, and for head of household is $21,600, but for married, filing separate, and single is going to be $14,600. So again, pretty high deductions. So in that case, a lot of people do not do write-offs as much anymore. It is something that's still beneficial to look at and review. You limit it to $10,000 on the SALT, the state and local tax deductions there. If you got charitable contributions, if you're self-employed, there may be some options where you are going beyond the standard deductions. So that's always something to review as well. As far as the actual tax brackets themselves, the brackets have not changed. You still got the 10, 12, 22, 24, 32, 35, and 37. But what you'll see here is the actual amounts have changed. They've simply just been adjusted for inflation. So I'm not going to spend a lot of time on this, but let's take a quick example. If we look at that 12% tax bracket, so that second line down, go through two columns. We look at married couple. That's actually going to be the 12%, which is a fairly reasonable tax rate. Doesn't jump to 22 until you hit 94,300. And at that point, that 94,300, that's also going to include your standard deduction of that 29,000. So you're up at about $123,000 or so before you go from that 12% bracket into the 22% bracket. So this is a great example of a lot of times when we're working with our clients, especially once they've retired and they haven't hit the RMD age, where we're going to review their taxes prior to the end of the year and find out, okay, what tax bracket are you in? I'd argue if you're in that 12% tax bracket, let's say maybe you only spent 80 grand or had 80 grand of income, that means you got another 40 some odd thousand that you could actually take out and only pay 12% taxes, which is arguably, you're not going to see it much lower than that in the future. So the question is whether you do that to pad your savings, or better yet, whether you do a Roth conversion and slowly get that year by year out of that IRA or 401k. So it reduces your future RMD, and then what happens is that means you've got more control of your taxes once you hit that RMD age. And it's going to be a big tax benefit for yourself and eventually your beneficiaries if you're passing on that way as well. Another thing that we've seen is the just the bump up as far as the dividend tax rate, it's still going to be 0, 15, or 20%. For most of you, you're going to be in that 0 or 15%. It takes quite a bit to get above that 20% level. But again, this is something that's very beneficial in conversations with a lot of our clients that actually have NUA when it comes time for exercising NUA on their stock if they have a 401k that has low cost basis company stock in there. So again, something to review with us if you have questions there. As far as the marginal tax rates, like I said, they didn't really change. The top rate still remains at 37%. Just the income adjustments across the brackets bumped up a bit for inflation. And again, I just mentioned kind of one strategy to reduce taxes over the long term. There's a lot of other strategies, especially if you're self-employed or if you're charitably inclined. So there's too many to kind of go through on this quick webinar. But if you want to review your specific situation, we can kind of go through that one-on-one and go through a lot of different potential reviews if we take a look at your taxes before the end of the year and what you can do to help save taxes for when it comes time for filing those April 15th of next year. As far as retirement accounts, so those of you that are still working and contributing to your 401k or IRA, those limits have gone up a little bit. As far as the 401k contributions, they went up $500 this year. So now you can put up to $23,000 into your 401k on a pre-tax or a Roth basis. The total amount is going to be $69,000 between you, after-tax employer contributions, and things like that. The max for an IRA is going to be $7,000. For those of you that are over 50, you get catch-up options, an ability to kind of catch up on savings. So for the IRAs, it's going to be $1,000 that you could do. For the 401k, it's going to be $7,500. And if we fast forward to 2025, that limit's going to go from 23,000 up to 23,500. And a unique option based upon the Secure 2.0 Act is for those that are 60 to 63 are going to have a unique catch-up option of, I think it's 11,250 instead of that 7,500. So again, another benefit if you're trying to catch up in this case. As far as the required minimum distributions, we talked about the Secure Act there. That's been bumped up to age 73 or 75, depending upon how old you are. You still have QCDs, the qualified charitable distributions from your IRA. That hasn't changed. That starts at age 70 and a half. You can go up to $105,000. And what that is, that's a direct contribution from your IRA to a charity, and that's going to be tax-free. So you're able to kind of get some of that money out of your IRA and avoid paying taxes on that for yourself or your state or your future beneficiaries. And then obviously, if you can afford to do it, you want to look at increasing your contributions year by year. It can be gradual, bumping up 1% each year, and slow and steady. It's going to pay off in the end, and it may not take out as much of a chunk as you think. It's also important to review whether or not, hey, should I be making pre-tax contributions? Should I be making Roth contributions? Should I do after-tax contributions so I get a backdoor Roth conversion strategy? There's a lot of options for those of you that are still working to review in this situation as well. As far as the estate and gift tax, those are still pretty high. This is one of the things we had a great concern about, depending upon how the election played out. There were talks about this coming back down to the pre-2017 levels and adjusted for inflation, which would be a big drop and get a lot of people into that state tax planning situation. But right now it's up at 13,610,000. So not many people are affected by it. Yes, there are some affected by it, and we do work with those individuals too. But for most of you, you're not going to have to worry about the estate tax because of the high level, and especially if you're passing on to your spouse first. But again, from a long-term planning strategy, it is something to look at, and we do offer estate planning services and reviews to look at that for you. The annual gift exclusion is up at $18,000, so this is something that can be done year by year, doesn't count towards your estate or gift tax exclusions. So this is per person, two person. So let's assume that you wanted to help out one of your kids or wanted to gift to them prior to you passing away. You want to see them use some of those assets versus just waiting until you're gone and pass it on to them. You can give $18,000 per year and not have to worry about keeping track of it with the gift tax exclusion. So that could be, if you're a married couple, that could be each of you can give $18,000 to one child. So that's 36 grand. You could also do it to a grandkid if you want. You might have a child with 5 kids. So there's a lot you can get out of your state there without going into the gift tax exclusions. Also, if you're thinking about helping out with college, a 529 allows you to front load that gifting. So you can do 5 years worth of gift exclusions if you want to front load it. And if you're looking to pay directly to the school, there's ways to do that as well. there's a lot of different kind of tax planning strategies around gifting. So again, if you're trying to get some money out of the estate, give us a call. We can kind of go through that with you as well. Some different, special tax tips and provisions to kind of be aware of. This doesn't affect everybody, obviously, but if you're looking at adopting, which is great if you can't have kids and you're looking to add to your family, there's a tax credit of 16,810 that's been adjusted for inflation for you. If you're working abroad, we work with a lot of clients that do work overseas. So that first 126,500 is going to get that foreign earned income credit. If you're a couple, you guys can both do that. So that's 126 times 2 in that case. So again, questions on there, let us know. We can dig into it. But for a lot of the clients we work with, their companies do provide some of that tax planning services for them. Make sure you understand capital losses in capital gains. That's not going to be in your IRAs or 401ks, but if you got after-tax money, you invested in stocks, and maybe you picked a loser, it might make sense to actually sell some of that, realize those losses, and sell some of your others that have gains and offset those, so it cancels them out. You can also actually carry forward $3,000 a year of capital losses to your actual earned income, so something to be aware of there as well. If you have any questions, just let us know. And the impact on specific tax situations, that really is going to be individually based. So any questions you have, let us know. We can go through there. But especially those of you who are maybe retiring, transitioning, you're self-employed, you're charitably inclined. There's a lot of different options that could be unique special situations to dig into. But again, let us know. We can dig into that with you. As far as kind of planning, some of the different tax planning tips we'll talk about in just a moment. Preparing for tax season. Again, like I said, it's best to prepare before the end of the year instead of waiting until after you miss some deadlines there. And the conclusions and next steps, which obviously going to be looking at working with us to run a plan and see where you stand. So some of the different tax planning tips, again, that's just a quick example of many, but leverage increased deductions and exclusions. So again, we talked about the deductions going up. When we say leverage that, it may be that you could have been retired and just been, hey, I'm comfortable, happy. We're only spending 60 grand, so we've been in the same tax bracket. But it could be that if you look at it, you've got a big enough nest egg that you may have wasted the last couple of years of some Roth conversion options. So it's something to look at going forward. It's also important to understand, some of the ins and outs of that, where it may look like on paper, hey, I should do a Roth conversion because I'm in the 12% tax bracket, but you could be low enough that you're not getting taxed on your Social Security, and a Roth conversion could jump that up and cause you to pay tax on Social Security. So it could be a little bit extra tax than you expected. Or it could be you're in a higher tax bracket and you want to do a conversion and it kicks you up into the IRMA where you're going to pay higher premiums on your Medicare. So a lot of things to go into on a one-on-one basis there. Review your investment strategy. We talked about capital losses, carrying those forward. But there's a lot more that you can do on that. So again, you want to typically look at tax loss harvesting on your non-IRA accounts leading into the end of the year. So it's important to review that. And obviously consider a consultation with a tax advisor. We can give you a lot of information, but at the end of the day, if you want to get more nitty gritty and confirm what we're talking about, you can consult with the tax advisor to go through some of that as well. So preparing for the tax season, again, organize your documents, get all that prepared early. Our suggestion is to get it done before the end of the year, so that way you can have an estimate of what your taxes will look like, and we can make some last minute plan adjustments for you. Beware of the new deductions and credits we just talked about, and like we said, consider professional tax help if you've got something that seems a little bit more complicated than normal, especially if you're transitioning, you've got NUA, or you're going from employed to self-employed, or you got real estate, rental properties, things like that. There's a lot of things that can happen. So the conclusions, like we mentioned, are just kind of recap some of those changes. Again, there's no real changes to the tax brackets. Those are staying the same. Just the amount has been adjusted for inflation between the standard deduction and the caps on the different rates. So again, I mentioned before, a married couple making about $123,000 and less is going to be that 12% tax bracket. So if you're making less than that, that's probably a good idea to review some different options there. If you're making more than that, it jumps to 22%, then 24%. So again, some different reviews there. We talked about the Secure Act, some changes to the RMDs, qualified charitable distribution options, things like that. As far as like I said, going forward, it's better to proactively look at this stuff, run an estimate, say, okay, what are my taxes going to look like in 2024? We like to tell people to run that in October, November, so that way we've got some time to make any adjustments if need be to the 401k or Roth conversions. A lot of times, if you wait till January, it's too late. You've already passed that year. There are some different options you can review, but again, plan early and be proactive about it in order to see where you stand going forward. And then ultimately, the best way to kind of tie this together is doing a financial plan, not just taxes, but your entire financial plan. But right now, about three-fourths of Americans over 50 don't have a written plan. If you can spend about 10 to 15 minutes with us, we can gather some data from you. Different items like income, we can do Social Security estimates, what you want to spend in retirement, when do you want to retire, your balances, 401k, pension options, things like that, and go through and tell you, hey, are you on the right track? Can you retire when you want to? Could you retire earlier, or do you need to work longer? What are some different tax strategies we can look at? What are some investment strategies to look at in order to make those changes? So again, a lot of stuff we can go through with you. Give us about 10 to 15 minutes to gather the information, and in a couple of days we'll get that report back over to you as well. So that kind of leads into, again, who the retirement group is. I know we've talked to a lot of you before, but we are an independent financial advisory firm that focus on working with corporate 500 employees and helping them transition into retirement. So a lot of our advisors are experts or focus most of their time on a select few companies. So it allows us to have the ability to have a deep understanding of your pension plan, your 401k, your healthcare benefits, your life insurance continuation options, things like that. So we can walk you through a cash flow analysis to show you when the right time is to retire, so you maximize those benefits from your company. Even though we work with them extensively, doesn't mean we're endorsed or employed by them, but again, give us a shot to at least let you see where you stand and help you as you transition to retirement. But we do have offices across the country, so rest assured if you need to sit down with somebody face to face, we can likely accommodate that. And then obviously we can do phone calls, emails, web meetings, whatever your preferred communication is. But at a minimum, take us up on that cash flow analysis. That's the best way to really kind of put pen to paper. I was talking with a prospective client, yesterday that said, I had an idea. I thought I was going to run out of money in about 15 to 20 years, but now we ran the plan. Instead of knack and math, we can see exactly where that is. And now we've been able to go in there and make some minor adjustments to show them that, hey, just a couple tweak here or there, and you'll be good into your late 90s. So again, it's important to kind of see this, and especially it's something good to sit down and share with your spouse if you guys are trying to plan together. So with that, I'm going to kind of wrap this up. I'll give you a couple links here, and we'll see if we had any questions come through. But you can reach us at info@theretirementgroup.com. You can call us at 800-900-5867. There's a couple QR codes up here if you want to follow along with us on LinkedIn, get updates on plan-specific seminars or webinars. There's a QR code there. There's also one to get into our calendars if you want to schedule an appointment with myself or one of our other advisors across America. You can get in there and do that as well. So with that, we're going to wrap this up. I did see 2 questions come through, so I'll get those taken care of and let you guys go. First question was, can I donate my RMD to avoid the taxes? Okay, so this kind of gets into where I was talking about the QCDs. So the answer is yes, potentially. It depends upon how big your RMD is. So the limit on the QCD is going to be $105,000 a year. So let's say theoretically you had an RMD, you've done well and you saved a lot and your RMD came out to $120,000 and you said, hey, I don't need any of that income. I want to give that away. I want to minimize it and I don't have maybe kids to pass it down to, and you're charitably inclined. You can do $105,000 of that direct to a charity, so that portion is tax-free. The remaining, what is that, 15,000 would be taxable to you. So if your RMD is, let's say, only 70,000, you can do that full 70,000. You can also do beyond that, above that, getting up to 105 if you want to get more of that out more rapidly. That also gets into the aspect of whether or not it makes sense to do a QCD or whether you want to provide more to your beneficiaries and do a Roth conversion or a combination of the two. A lot of that goes into the planning. So just give us a call. We'll be happy to kind of walk you through that. One other question. Unfortunately, in this case, this person says, I think I'm going to get laid off. How can I access my 401k without the penalties? Typically, we do provide a screen on some of these options. We didn't do that on this one, but unfortunately for this individual, hopefully they do not get laid off. But if you do get laid off from your job, there are some different issues to be aware of with your 401k or an IRA. And a lot that depends upon your age. Generally speaking, with a 401k, if you've put in pre-tax money and the company contributions are obviously pre-tax, you're not going to be able to tap into that without a penalty until 59.5. So what's going to happen is you'll pay taxes on it plus a 10% penalty. Now, if you are age 55 or older when you separate from this job, you can actually take distributions from that 401k without that 10% penalty. So it's important to understand that and not just quickly move it over to an IRA. The other option is if you're not 55, you can move it over to an IRA and set up what's called a 72T, or substantial and equal periodic payments. As long as you make those for at least 5 years or until you turn 59 and a half, those will be penalty free. Again, not tax free, but penalty free. However, if you're younger and you're thinking about going back to work, that's something to be cautious about, because once you start that, you have to keep doing it. Otherwise, if you make a change to it, the IRS can come back and retroactively penalize you. Some other aspects, if you're doing a first-time home purchase, up to $10,000. If it's unreimbursed medical expenses, in some cases, if you've been unemployed for, I think, 12 months or longer, you can do pay your medical premiums, health insurance premiums. There may be a couple others, but just give us a call. We can kind of go through that with you, because if you are unfortunately getting laid off, it's important to also review your 401k, where you stand there, your pension options, and really run a cash flow analysis we talked about. Maybe not for the typical reason of, hey, I'm retiring, but maybe backing into what do I need to earn for the next 5 or 10 or 15 years to meet the goals. So again, something we can provide for you. So again, with that, I want to wrap it up. Just any questions you guys have, give us a call. Again, I mentioned we do work with a lot of individual companies, but that does not mean we're endorsed by them or employed by them. But give us a shot. We'll be happy to dig into anything you have questions on and help shed some light on that. But again, you can reach us at 800-900-5867. Thank you very much. We hope you have a great day.